Europe stocks sharply lower after US and Asia sell-off. European stocks have fallen sharply as concerns about a trade war and higher US bond yields have stoked concerns among global investors. In London, the UK's FTSE 100 share index fell 1.7% to 7,023. Markets in Asia had plunged to a 19-month low after US shares suffered their worst losses in 8 months. US President Donald Trump called the fall a correction, but said the Federal Reserve, which has been raising interest rises, had gone crazy. The global sell-off came as International Monetary Fund head Christine Lagarde said stock market valuations have been extremely high. In Paris, the CAC 40 share index was down 1.7% at 5,119 points, while in Frankfurt the DAX index fell 1.3% to 11,559. The FTSE 100 and the CAC 40 have fallen to their lowest levels since April, while the DAX is at its lowest since early 2017. Markets in Asia had followed US stocks, which slumped on Wednesday. Japan's benchmark Nikkei 225 dropped 3.9%, its steepest daily drop since March. In China, the Shanghai Composite fell 5.2% to its lowest level since 2014. Why are the markets falling? For the past year, stock market experts have been predicting a big fall. It was something of an obvious forecast. Most markets are at or near all-time highs, particularly in America, where investors have enjoyed the longest bull run ever. What goes up must come down, the only question was the timing. In the last year, there have been even more signs of so-called melt-up phase of a bull market, where share price increases are concentrated in just a few very large companies. Apple, Facebook, Google and Amazon have accounted for most of the increase in the US markets in the past 12 months. The trigger for the latest fall has been a sudden flight from American government debt. Investors have started to sell down US government bonds, the IOUs it issues to fund its deficit, thinking that they are no longer a good value investment. This has in turn triggered a bout of realism on the stock market. Worries about a trade war have added to this new mood of caution, and it is worth noting that yesterday several big US companies warned that tariffs on Chinese imports were starting to hurt their business. One oddity of this particular market drop, traditional safe havens, like gold and, perversely, US government debt, have hardly moved in price. This suggests investors are uncertain of what next, a big fall or another rally, and are happy to sit on cash. Trump attacks crazy Fed. US markets have done better than expected this year, bouncing back after turmoil early in the year to set new records over the summer. But the Federal Reserve is raising interest rates, with the latest hike coming last month, and more increases are likely to come. The Fed last month abandoned its description of its policy as accommodative, reflecting a view that the economy is strong enough not to need the kind of stimulus it received in the aftermath of the financial crisis. The prospect of dwindling US stimulus has been compounded by a trade war between the world's two largest economies, which the IMF has warned could harm growth. US President Donald Trump has been particularly critical of the Fed's rate rises, breaking with tradition in the US where presidents are expected to respect central bank independence. "The Fed is making a mistake," he told reporters on Wednesday. "I think the Fed has gone crazy. Correction well overdue." However, analyst Michael Hewson of CMC Markets said it was too simplistic just to blame the Federal Reserve for market turmoil. "There are a number of factors," he told the BBC. "Obviously, concerns about slowing growth. The IMF downgraded its global growth forecast for the global economy, citing emerging market concerns," he said. Mr. Hewson added that trade tensions between China and the US had weighed on Asian markets for most of this year, while trade tensions between the US and the EU had hit European markets. Concerns about the political situation in Italy were also adding to market nervousness. It's a well overdue correction, driven by U.S. markets, which have outperformed for most of the past 2 to 3 years, he added. Simon French, chief economist at Panmure Gordon, told the BBC that what was really quite interesting is the speed with which the sell-off is taking place, adding that there has been a pattern over the past few years of markets hitting new highs followed by sharp drops. He added, when you've got the president of the US saying some quite unpleasant things about the Federal Reserve, you don't necessarily expect it in the US. That's made investors say given those gains, we'll bank some of them, and take money off the table.